Emmanuel Sain Safali bring you the Promise Show. And today we want to speak about credit debt because many of us are wobbling in debt every other day. And yes, some of us can pray like this gentleman here, but then I would like to start with this article that featured in the New Vision. It was titled, it was on Thursday, 3rd, it's not so clear, but I can see it's titled, Legislators Raise Concern Over Credit Insurance. So let me just make it a little bit more visible so that we can just read through some of the details that the journalist Nelson Muhoozi wrote. So he talked about how MPs have raised concern over alleged fraud in credit life insurance, accusing commercial banks of imposing unfair additional costs on borrowers. Lawmakers argue that banks exploit clients by embedding hidden insurance charges in loan agreements, increasing the financial burden on unsuspecting customers. During a recent parliamentary session, Butambala woman MP Nalule Aisha Kabanda highlighted that banks charge insurance on loan amounts. However, she noted that a growing concern where banks impose a second insurance charge where borrowers request a top-up even on the portion of the loan that has already been insured. If a borrower has a remaining balance of 40 million and seeking a top-up of 100 million, bringing the total to 140 million, banks charge insurance on the entire amount. This means the borrower is effectively paying insurance twice the original 40 million, which was already been covered, Kabanda says. Okay, she questions the fairness of the practice and urged government to introduce regulations to prevent financial institutions from double charging borrowers. State Minister for Finance Henry Musasizi responded that the issue is contractual between banks and the clients, emphasizing that government does not intervene in individual agreements. If the terms of the loan are unfavorable, borrowers have the choice to decline it. The Finance Ministry does not negotiate on behalf of clients, Musasizi stated, reinforcing that banking relationships are governed by agreed terms between the lenders and the borrowers. However, Otuke County MP Paul Omara noted that the loan insurance is a global standard practice. He explained that loans carry insurance for a set period, as agreed upon by the borrower. If a borrower initially takes out a 2-year loan and exhausts 1 year before seeking a top-up, a new top-up loan comes with a fresh insurance charge. This is part of the standard banking operations, and neither Finance Ministry nor the Bank of Uganda regulates such individual charges, Omara explained. He added that banks are required to display the hidden charges publicly to ensure transparency. So this is banks. Calls for customer protection. Busiro East MP, who happens to be my MP, Medad Lubega Segona, expressed disappointment with government's response, urging that the issue raises critical consumer protection concerns that the Bank of Uganda or the Finance Ministry should investigate. The cost of credit in Uganda remains high, and hidden charges such as these further hinder economic growth. The Finance Ministry should be looking into these concerns rather than dismissing them, Segona said. Deputy Speaker of Parliament Thomas Taiwa echoed this sentiment, stating that the Parliament must listen to consumers' grievances and push for regulatory oversight. When consumers approach Parliament seeking intervention against unfair banking practices, it is often our responsibility to listen. These are ordinary Ugandans who may not fully understand the technicalities of financial agreements. We should not disregard their concerns. I have said that the government is drafting a consumer protection law to provide an official framework for addressing such complaints. Attorney General Chirewa Chiwanuka assured Parliament that the government would investigate the matter and determine further the current loan insurance charges and comply with banking regulations. This debate highlights the growing concern about consumer protection in Uganda's financial sector, particularly regarding transparency in loan agreements. Many borrowers, particularly small business owners and salaried employees, rely on bank loans for capital and personal development, making fair banking practices crucial for economic stability. So this is the insurance sector perspective. Okay, let's listen to what Protaz Sunday, the Director Planning, Market Research and Development of at the Insurance Regulatory Authority, explained that if a new loan agreement is signed, the charges change accordingly. He added that if the bank loan is extended and the installments increase, insurance charges should also increase. But if the payment period and installments remain unchanged, the charge should remain the same, as you clarified. Okay, regarding the financial institutions failing to remit credit life insurance charges, he said that such practices are unprofessional and risk for the banking industry. I think just to clarify here, we have seen some instances where banks actually charge these insurances, but clients never get these policy documents. So you as the clients out there, my advice is you should actually get your policy documents from whichever insurance company you have chosen, as we're going to see shortly. Ernest Burase, he highlighted that credit life insurance covers the borrower's death and eventual job loss. Well, that is subject to discussion and terms depending on the policy you've gotten. Some financial institutions extend coverage to permanent disability, critical illness, and funeral costs. Consumer awareness. Protazio emphasized that financial institutions need to educate borrowers about the credit life insurance to clear misconceptions. Borasia advised borrowers to inquire about the specific risks covered and the insurer providing their coverage. Francis Ogwang, the chairman of the board at the CIC Africa Life Insurance Uganda Limited, said that they are sensitized in circles about the benefits of insurance. He acknowledged that while some circles fail to remit the charges, most comply with the insurance requirements. So the banking industry response. This is Jonathan Lumu, the bank assurance manager at Housing Finance Bank, said that when loan periods are extended, an additional insurance premium is charged on the existing loan. The practice is that banks charge credit life insurance usually 1% or less. However, failing to submit these charges to insurers is risky. While this may happen in circles, banks that follow strict compliance measures rarely fail to remit the charges. He said, Lumu said that the clients are given choices regarding the insurance and sign loan agreements with full knowledge of the terms. However, he noted that some banks, due to their large customer base, may not always provide the insurance certificates. And this is something that has to be pointed out. You, the clients, are supposed to ask for this kind of policies. So this is credit insurance, the legislature flag petals. So market trends, well, I can go into it, but I think you can read for the rest. I just wanted to also highlight this article that came out in the same period. This is Daniel Kalinaki, the managing editor at Nation Media Group, and he said, choose your insurer wisely or you will pay more than a premium. Let's listen into his story. Actually, before we listen into his story, I'll just point you out to his article that featured, well, I had to Google some of these things. This is the article where he says, this was on 24th of March 2025. He said, I've spent 6 months chasing an insurance claim from the recalcitrant Sanlam, Uganda. Even after being directed to pay by the IRA, they continue to dodge, delay, and dither and dilly-dally. Choose your insurer carefully. Well, if you go under that thread, there are so many responses, but finally, the good news is he got finally paid by Sanlam. But let's listen into his article because he actually gives some other insights that the public may understand or may appreciate better. Because this cuts across, not just to Kalinaki's story, as he's going to actually explain. He says, ordinarily an subservience of the temperamental reticence that has served me well for so long, I wouldn't take a private fight to a public square. Yet many anecdotes shared after my little tiff with a local insurer have shown the depth of the problem and justified the means. The details of the provocations and prevarications that led unnecessarily to our public duo need not to be revised, but I hope that having lost the war, my now former insurer will not lose the lesson. The insurance industry as a whole might in fact even be well served by taking a long, hard look at their practices, then having a conversation with their customers. Insurance is a risk mitigation strategy. To the customer, it is like a car seat belt. For me, in most times, I actually call it like it should be like a car jack or a spare tire. It does not prevent an accident from happening, but it can reduce its impact. The fact that many motorists get to their destination safely without wearing their seatbelts does not make the safety device unnecessary. When accidents occur, however, those seatbelts tend to have better outcomes. Those seated in seatbelts, tend to have better outcomes. Like in insurance, it is better to have it and not need it than to need it and not have it. Very key point. To the industry, insurance is just mathematics, probability to be precise. That done right prints money. You estimate the odds that an insurable event sign up enough customers to cover the costs of those fate will drive to claim. Then pocket the difference. Less expenses. Insurance firms even hedge against the risk by selling it on to reinsurance companies. Essentially insuring themselves against the customer that they insure. Most Ugandans only deal with insurance companies when they need third-party motor insurance, and only because it is required by law. To many, it is merely an extra tax on the car owner. Actually, many call them Omsologwa government. I've talked about motor third-party before on this channel. You can go and sell it out. They do not read or claim when an insured event occurs. Over the years, insurance companies grew fat and lazy on this easy money. It undermined the growth of the genuine relationship with the customers, and instead created a culture in which customers are expected to hand over money, get a typewritten windscreen sticker to show to the traffic policeman, go away quietly, and repeat in 12 months. New insurance products followed this same give me your money and walk away slowly dynamic. Medical insurance became a talent attraction and retention tool by employers and a business-to-business offering, not something to pitch to, explain, or sell to customers. Bank borrowers with insurance premiums tacked on their loans never knew what, when, or even if they could trigger a claim when they or their businesses failed. That is also very key because we're going to discuss bank credit, as the MPs have been complaining about. Accustomed to shooting fish in a barrel and having grown up with little adult supervision, many insurance companies fail to develop their customer service muscles or the need to explain what they need to offer and why clients need to buy it. Clients are entirely blameless. Many are too short-sighted to read the fine print of what their policies don't cover and too lazy to claim what they do. The few with the shutza to claim, shutza, this guy uses very complicated English. I just had to Google it, to get the pronunciation. But it means, it is
Chutzpah.
It's an extreme confidence, self-confidence, or audacity. Love him or hate him, you have to admire the Cohen's shutza.
Chutzpah.
Chutzpah. Yes, actually that's the word. So let's go back to the article. Because he said, the few with the chutzpah to claim often quit when they run into the poison ivy of corporate double speak, obfuscation, and just plain old lying. Few have the platform or the profile to fight back. As someone said, insurance clients are sold premiums by pretty hot chicks in high heels who smell fragrant like chilled rose in a warm, lazy Sunday afternoons. When they come to claim, they are met by pot-bellied middle-aged men who are pageant and they're prognacious. Oluzungu, too much English. Let's just look for the meaning of prognacious. Okay. It is there. Eager or quick to argue, quarrel, and fight. Those are the officers of insurance, the pot-bellied officers Daniel came across, possibly when he came to claim. Okay, this is a very good feedback, but of course we take it in goodwill. None of this is good for the industry. Without trust in insurers, few people will appreciate the need for insurance. The resulting smaller pool concentrates risks and leads to more duels, further eroding trust. The Insurance Regulatory Authority must lean on industry players to be more transparent about their products and processes. A public performance tracker on key metrics akin to what Uganda Communications Commission and the Central Bank do for telecoms and banks, respectively, would be a good start. None of this should shake your faith in insurance, dear reader, but it should steer you to read the fine print, ask questions before you pay, shop around, use a brokerage if possible, and speak out if you end up holding the short end of the stick. If you don't choose your insurance properly, you will pay more than just a premium. Very good article. Thank you so much, Daniel. I really have to commend you for sharing with us your experiences and actually giving us very good feedback as an insurance industry. Okay, now let's go back to the gist of the matter, because this article here by the legislators also gave us some good insights of what's happening. If the legislators, the parliamentarians can find that they're also being siphoned or they don't know exactly what the insurance is all about, what about you, the common person, the Muntu wa wansi? So let's go through just briefly what insurance is all about. So credit, a contract agreement in which a borrower receives a sum of money and something of value and repays the lender at a later date, generally with interest. Okay, that is very well understood. So let's do this. Two kinds of credit policies. There is one, I'm going up for the purpose of not disclosing the insurance company. These are just a few loan agreements. So this is the group credit insurance, usually taken out for what we call the unsecured loans. The group policy for those salaried people who have, they get some small salary, they go to the insurance companies, they go to the banks. The banks negotiate on their behalf the kind of loans they can have. Let's say this was an example for a bank giving out up to 20 million shillings. But then, of course, there are those categories of clients who are salaried, but they can get more. But again, those ones, they take them to another class of credit. So the group credit, ideally, the majority would take about 24 months, which is 2 years. Some can negotiate to even more years. But of course, depending on the contract you have, this is just an example, let's say, use that would happen. So they would consider people in their 18 to maybe 70 years and covers worldwide. And if we look at the next, of course, some of these are some of the terms. Yes, this is the other term that we can look at. What are we covering against such loans that you are being charged for? So if you have taken out a loan of, say, 20 million, okay, they are telling you we're going to cover, first of all, the events. We're covering, say, death resulting from either natural or accidental causes. They pay 100% of the loan amount, plus maybe some interest. Then we can also cover total permanent disability, disablement, 100% of the loan amount. Critical illness leading to inability to engage in income-generating activities. We can pay up to, say, 30% of the outstanding loan balance paid as a lump sum subject to a waiting period of 3 months effective from the loan disbursement date. Okay. Funeral benefits, accidental death benefits, let's say we can pay up to maybe 400,000 on loans above 800 and 50% of the loan amount in case of loans below 800,000. So things like that are given. Natural death, we can pay up to, say, 200,000 paid for loans above 400 and 50% for loans. So things like these are given. And then they will charge a rate of about 0.55%. This can be negotiated depending on the financial institution. And usually, this you can't really commit so much how much they're going to charge you, because these are negotiated by financial institutions. So let's take this small example. We had said, say 20 million. 20 million times 0.55% is going to bring a premium of about 110,000 shillings. Are we together? That is for the whole year. Maybe they will put in some small levies, like on top of this, they will charge you another 0.5%, 1.005, and then add in a stamp duty of 35,000. Yeah, maybe about 145,000 is what they will charge you. But that, you can see 145,000 for a loan of 20 million, and they're giving you all these kind of benefits. So that is for the group. Now, what happens to the members who have bigger loans, who come into what we call, there's another cap we call mortgage protection. Of course, now this is age-based. This is someone, say, born in 1987. At that time, they were about 36 years, and they're taking out a loan for about 5 years. You'd find that the premium here would charge, if this person was taking out a loan of 1 billion, would charge a certain rate. They charged a certain rate for this person, about 7.8. It came down to about 1.7. Okay. No, yes, this is 7.8, the basic premium. Then the total premiums plus the taxes came to about 9.5. So on average, about 1%. It was slightly less than 1%, about 0.9% to be exact, plus the taxes. So the premiums go on reducing balances. But you can see, once this person pays this premium, they're supposed to get a cover worth 1 billion. Should anything happen to this person, the insurance company has to pay so much money to the bank so that they cover the cost of the credit. So many times, if you allow the bank to pay this premium to the bank and you don't actually follow up by yourself, you're going to be losing out. Actually, some banks have a very notorious habit of not remitting the policy documents, even 6 down the road, which is very, very unprofessional. And the regulator actually stated in his response that actually that is very unprofessional and can cause for them to lose their license to get the bank assurance license. So let us, and of course, as you can see from these statistics, they are showing that IRA bank assurance now accounts for about 11% of the total premiums, up from 9% in 2022. So which is good. They are growing, but also the consumers have to also be protected, because you're taking out very big loans and credit, and we end up, keeping in debt. Someone pays loans, but they are not having a policy document. So what happens? You who has taken your business to the bank and you don't get an insurance policy, yet you are charged the insurance premium. This is a call to action to all of you out there listening to my presentations. Whenever you are going out for loans, Don't be so quick to look for the money and forget the insurance part that the bank is actually very keen about. When you let the bank negotiate your insurance policies for the clients who are taking out their individual mortgage plans, you risk getting a raw deal. You can actually get your own insurances, share with them if they want the lien clause. Lien clause means they will have their name embedded. So if there is a certain person called Emmanuel Safari taking out the insurance policy, maybe if he wants to get to show the lien clause to that bank, he'll put a stroke ABC bank, something like that, such that you don't get the short end of the stick. You have to choose your insurer very wisely. And even the bank, whenever they tell you they are choosing for you, be very careful. Just like Daniel Kanalaki elaborated, you will end up paying more than just a premium. Don't be too fast, but always endeavor you get the service. That said, I remain Emmanuel Safari, bringing the Promise Insurance Show, reminding you to hope for the best and while preparing for the worst. Blessings to all of you.